Listen closely. Gold is rapidly approaching a major liquidity zone right now, and smart money is actively setting the board for the next big expansion. Our primary focus for today's analysis is a highly specific bullish setup on XAUUSD, and we're targeting the 4437 external liquidity pool. If you're trying to navigate the markets today, you need to know exactly what the institutions are engineering.
So looking at the daily time frame, our primary focus is a bullish continuation. After that multi-month corrective decline, gold delivered a really clean structural expansion, leaving this massive trail of unmitigated demand behind it. But here's the problem. Most retail traders are looking at the completely wrong level right now. They're staring at these recent intraday highs, trying to aggressively short the market because they're anticipating some massive reversal. Let's look at exactly what they're missing and where the real opportunity actually is. Before we get into the weeds of the order flow, here's today's exact institutional execution plan. Our bias is a bullish continuation. The precision entry zone we are hunting is strictly between 43.88 and 43.95. Our ultimate draw on liquidity, the primary target is the buy-side liquidity resting exactly at 44.37. And the catalyst that's going to spark this entire move? The upcoming US CPI data release. The market is setting the stage, and this is the blueprint. But you know, there's a catch. This is where smart money may create the ultimate trap. You see, this impending US CPI data changes absolutely everything about how this setup is going to unfold. The market is currently flashing a massive warning signal to early breakout traders. And honestly, if you don't understand how institutions use high-impact news events, you are literally going to become the liquidity they need to fill their orders. Section 1. The smart money draw on liquidity. To understand the trap, we first have to understand the magnet. Let's drop into the top-down analysis because you can see exactly why institutions are systematically attacking this specific level. On the 4-hour time frame, notice these strong bullish order blocks controlling the price from below. We've had massive displacement away from the discount arrays. That means buyers are in complete institutional control. Now, contrast that with the 15-minute time frame. We just have this choppy intraday consolidation. Smart money already accumulated their massive positions down below, and right now they are patiently waiting for all this intraday noise to settle out before expanding higher. They're protecting that 4-hour structure while engineering liquidity on the 15-minute. So the crucial part here is mapping exactly where the money's actually resting. Our primary magnet, the external buy-side liquidity, sits up at 44.37. This is a major swing high. It's a high-resistance liquidity pull that acts as the ultimate draw. Now, just below that, we have internal buy-side liquidity at the recent session high of 44.14.50. But take a look at the downside. We have this tightly coiled internal sell-side liquidity, sell stops resting at 43.90 and 43.68. And crucially, sitting right below current price action, we have a highly probable 1-hour and 15-minute bullish fair value gap nestled perfectly right between 43.88 and 43.95.
Now factor in the macroeconomic backdrop. Obviously, we've got ongoing geopolitical tensions, like the US-Iran situation in the Strait of Hormuz, which is driving oil prices and keeping safe haven flows active in the dollar. But when we look at the upcoming 7:30 p.m. US CPI release, you really have to shift your perspective. This CPI release is not a fundamental trend driver, it's an institutional liquidity engineering tool. Institutions don't trade the news. They use the volatility generated by the news to access liquidity pools that would otherwise be impossible to reach without massive slippage.
And that brings us to a really foundational smart money concept, the Judas swing. By definition, this is an initial aggressive price purge down into a discount array, and it's designed specifically to sweep pre-session stop losses before a rapid displacement in the true institutional direction. So going into the CPI release, institutions are highly likely to engineer a Judas swing downward. Their goal is to trigger those sell stops resting below 43.90, purge that liquidity straight into our bullish fair value gap, and grab those contracts at a massive discount before sending the price upward.
This is the exact scenario most traders are completely ignoring right now. Retail traders are going to see that pre-news consolidation and try to impulsively buy the breakout, only to get chopped out. Or they'll see the sudden violent CPI drop and immediately short the market, panicking, thinking a crash is happening. That's the trap. Smart money, on the other hand, they aren't doing either. They are sitting on their hands, patiently waiting for the price to drop into that discount fair value gap, clear the stops, and show a 15-minute displacement back to the upside. Section 2. Executable ICT Trade Plan. Look, understanding the theory is only half the battle. Let's move directly into the precise execution mechanics and the strict risk management you need to actually capitalize on this. Here are the exact mathematical parameters for our long scenario. The direction is a buy. Our entry zone is the mitigation of that fair value gap strictly between 43.88 and 43.95. The stop loss has to be placed at 43.79, just below our structural invalidation point. Our first take profit, where we take partials and move the stop to break even, is the internal liquidity at 44.1450. And our final max target is the external pool up at 44.37. Structuring the trade exactly like this gives us a highly favorable risk-to-reward ratio of 1 to 3.2.
But listen to me carefully here. There is absolutely no actionable trade right now. Smart money confirmation has not happened yet. Before any capital is risked, 3 non-negotiable steps have to execute. Number 1, we must see a clear sweep of the internal sell-side liquidity. 2, price has to physically tap into our 43.88 to 43.95 fair value gap or order block. And 3, which is the most important, we have to wait for a 15-minute bullish market structure shift with energetic displacement upward. If these 3 triggers don't align, we don't trade. It's that simple.
We also have to respect the market's boundaries. 43.57 is our critical line in the sand. A decisive 4-hour candle close below 43.57 completely invalidates this entire bullish order flow model. If that level breaks, the narrative instantly shifts from a premium continuation to a deeper discount draw. That would mean the institutions are seeking liquidity much further down. Risk management is all about knowing exactly when your thesis is wrong.
Section 3, final strategy recap.
We've covered the higher time frame narrative, the liquidity pools, the CPI trap, and the precise execution model. Let's do a rapid summary to lock this in. Here is your core actionable recap for XAUUSD. The daily and 4-hour bias remains firmly set for a bullish continuation. The highest probability trade is a buy, but strictly upon lower timeframe confirmation. We're targeting an entry within the 43.88 to 43.95 fair value gap, aiming for that ultimate external liquidity at 44.37. And the most critical action you can take right now? Wait. Wait for the London or New York kill zone, and wait for that CPI liquidity sweep. Patience is your true institutional edge.
That wraps up today's analysis into the institutional order flow of gold. If you value this calm, precise, and structured approach to smart money concepts, consider subscribing to ICT Market Theory for more institutional-grade analysis. And if you'd like to trade alongside these setups, you can find the FXTM trading account link securely in the pinned comment below. So my final question to you is this: when that CPI volatility hits, are you going to be reacting to the noise, or will you be waiting in the shadows with the institutions? Trade safe.